said in his annual letter a few weeks ago that the firm could lose about $1 billion due to its Russia exposure, but didn't really detail where those losses would stem from. Another big wild card just for earnings among the banks in general is capital markets volatility and the impact on areas like underwriting and trading. And that's something that JP Morgan could be a bellwether for when we see their results come out tomorrow. But as you mentioned, it's definitely faced some pressure in recent weeks, in particular over concerns about that FIC group, its Russia exposure, and basically any unknowns that could come from Q1 results. Melissa.
Todd, the setup seems pretty good for JP Morgan in that it's down so much going into earnings.
Yes, Melissa, we hold it. We've reduced our holdings, and I'm looking to add back on. I haven't certainly given up on it. And as Leslie just said, the trading will be certainly important across the three asset classes. Then you look at equity trading, that'll be key. And then also look at the investment banking side. As tech valuations have come in, their IPO business will, probably come under pressure as well. And then obviously commodity exposure to Russia. But look, JP's got a great history of beating earnings. I think 17 of the last 20 quarters were a beat. They're fairly priced, 1.5 times book, 3% yield. As I said, I hold it in our portfolio. We started about 2 3/4 at the end of last year. We cut it down to 1%. If we could hold, about this 132, which is the 200-week moving average, about 130, I would be looking to add. And actually, despite what you said, Melissa, JP has fallen out of favor. But just in the last couple of weeks, we're starting to see a little bit of outperformance in JP compared to their big peers. We got to see what happens on their lending side. We saw it happen with consumer credit. So they're going to have to thread the needle on this report. There's a lot of factors at work.
All right, next up, Delta Airlines, the rebound in travel demand not helping shares down 21% in the past year as rising jet fuel costs and labor shortages caused problems for the industry at large. CNBC.com Airlines reporter Leslie Josephs got the story on Delta. Leslie, what are you looking for?
Well, we are expecting another loss, and that's not much of a surprise. Delta had said this earlier in the quarter. Every airline started this year with Omicron sidelining thousands of employees, causing flight delays and things like that. Getting later into the first quarter, they had this huge spike in jet fuel, and that's airline's biggest cost after labor. So are expecting another loss. Revenue is supposed to jump almost double from, more than double rather, from last year. So the demand is there and the costs are rising alongside it.
Todd, transports as a group have been terrible of late. I think they're down, 13% since the end of March. So Delta in particular, do you like this one?
I don't, unless I don't own any of the airlines. I don't like the fundamentals behind them. JP Morgan, ironically, just came out with positive comments saying they might be able to expand their margins. But look, you look at the performance of airlines, and Delta has not offered any outperformance relative to the S&P since 2016. Airlines are still not back in terms of filling seats to their pre-pandemic levels. I think there's better ways to play the reopening. Government regulation is still a drag. They're making employees and travelers wear the mask. They're trying to lift it. You look at what JetBlue just said. Last week, they cut 20% of their flights. They're trying to pay flight attendants to show up. Alaska's trimming flights to train new pilots. And the big question is, what impact will crude oil have on Delta? They don't hedge fuel prices. The way they're hedged is with fuel surcharges. So we'll see how effective that is. Delta did invest in their own refinery about 10 years ago. It was hard for them to make any money. They've tried to hedge in futures, and they reportedly lost about $4 billion. So I think the big thing will be the fuel charge, fuel costs in this earnings report. I won't touch it.
Leslie, airlines have always been able to have a fuel surcharge, and people in general have been willing to pay that. And so I'm wondering if the airlines' problem really is that labor issue, not being able to get those airplanes staffed up if they're having to cut capacity. They're actually being constrained in how much they can make simply because they can't staff up those planes.
Right. And you think back to 2 years ago when we were at the traffic low during the pandemic for travel. Now we're, we're at 87,000 2 years ago. Now we're over 2 million. They're trying to staff up as much as possible. The bailout prohibited the airlines from laying anybody off, but they did urge plenty of workers, tens of thousands of them, to take buyouts. Delta is among those airlines. It's kind of like throwing out your sweaters in July and then not having anything to wear in the winter. So airlines are quickly trying to staff up as fast as they can, especially that pilot shortage. We're seeing regionals particularly having to scale back capacity, and that's affecting the majors in that way. But people are ready to travel. We have data from Adobe today showing that fares last month were up 20%, so that inflation is there, and so far travelers are willing to pay. And Delta's commentary last month at the JPM conference, they said they are able to pass a lot of that fuel along to customers in the form of higher fares or fuel surcharges. That's for international travel on certain routes. But so far we are seeing those fares coming up, and tickets are getting gobbled up alongside of it.
All right. Leslie, thank you. Leslie Josephs. And a quick programming note here. Delta CEO Ed Bastian will join Squawk Box in an exclusive interview tomorrow, 7 a.m. Eastern Time, following the earnings release. Do not miss that. And finally, we get to Bed Bath & Beyond. The retailer down 36% in the past year. Bank of America today calling the company one of its, quote, top underperform ideas for 2022, with options implying an 18% move and a 22% short interest. Things could get interesting tomorrow morning. By the way, that's a move of plus or minus 18% in the options market. Courtney Reagan's got the story here on BBBY. Court.
Yeah, Melissa, before we sort of look at the stock chart action, which admittedly has been a little messy for a number of reasons, let's talk about the fundamentals. So Bed Bath & Beyond is in the middle of this turnaround strategy led by CEO Mark Tritton. Remember, he came from Target. People were really jazzed up about the idea of him introducing private label brands to increase margins and sort of reinvigorate interest at this company. The private brands are there. The sales are not so much yet. The company is forecasting those comp sales to fall in the high single digits here. And this is in a subsector, home furnishings, that's actually doing pretty well. Of course, we all know we were at home and we refurnished and we redecorated, and that continues even despite some inflation in this category. So then if you look at the stock chart, you see this bump that happened last month, and that's because Ryan Cohen got involved. Of course, Ryan Cohen had a very big involvement, or has a big involvement with GameStop, is the current chairman. So he's got a lot of retail interest and traders behind him. Bed Bath & Beyond was also one of these Reddit plays earlier on when all of that frenzy was really taking shape. So some of what we've seen in the stock price move is because of the involvement in Ryan Cohen. And Bed Bath & Beyond responded very quickly, in fact, adding 3 board directors after Cohen's involvement in a very short period of time. One thing that Cohen wants is Bed Bath & Beyond to look at spinning out BBBY Baby. However, he thinks it's much more valuable than some of the analysts on the street do. So I'm wondering if Bed Bath & Beyond doesn't have to give us a little bit more nitty-gritty details about that silo of the business and what it might be worth tomorrow when we hear more in-depth earnings. But this one's been kind of a messy one. The turnaround just hasn't taken hold yet.
Todd, is there a fundamental story there for you? I mean, a compelling one, enough for you to invest in it?
No and no, Melissa. Courtney just did a really good, thorough report on that. I wouldn't touch this with our investor money. This is a meme stock. I'll make a comparison on that in a sec. I mean, I think they're looking for 3 cents a share. That's a 90% drop from the same quarter last year. They're battling online retailers, Amazon and others. They're trying to do their own digital strategy in this turnaround. They are facing supply chain bottlenecks, potentially strained customer. They are still pulling back from that Ryan Cohen pop when he bought 9% and change of the company. You know, there might be breakout support around 17 if you want to trade. This is YOLO, meme, fun money. This is not investment as far as I'm concerned. And as Courtney said, they're trying to spin off the BBBY Baby. Cohen thinks that it's worth more. The market capitalization is worth more if they spin it off. Loop Ventures came out and just said no, strongly disagree with that. They face the same issues, higher staffing, input costs. It's going to pressure margin. But the stock isn't trading on fundamentals. It's a meme stock. And again, I just want to qualify this. I would not put this in client portfolios, Melissa. I might trade it. I mean, you know me from when I was a younger, crazy trader. But if you want a meme stock, look at GME. It looks actually a little bit better if you want to kind of trade it up through 190 and technical resistance. But unless you're trading this long-term and investing in a turnaround story, please don't touch it.
Okay, I like how you break into earnings exchange and sneak in GME because you know I'm going to bite on that one. You're saying GME is a better investment than BBBY right now?
No, trade.
Trade, better trade.
No, trade.
Okay.
A definite trade. Yeah, if you want to get your technical crayons, anybody at home, just put up a chart of GME. You could just draw a trend line right across the top. It actually just kind of bumped up against it. I kind of wish this whole meme stock thing would go away so investors can stay focused on what matters in here. But if you must trade, do it with small money, do it with options up through 190. It might get going again.